Wild markets out there, everything going on in Greece, Puerto Rico, huge volatility coming out of Asia. How do you trade markets like this when legitimately none of us have any idea what's going to happen with Greece?
Yeah, it's really hard. I think you have to take a little bit longer term view and look through some of the short term volatility as to what the lasting impacts might be. You know, we've long had the view that Greece and its situation, while it captures all of our attention and the headlines today, really doesn't have the same kind of connections to the global financial markets that it did back in 2009, 10, and 11, when Greek issues like this really could cascade into a much bigger systemic risk. So it's a very fluid events as you're reporting on, and so it's very hard to see exactly how that's going to play out. But the spillover effects, absent a very disastrous outcome, are probably more contained than we've seen in the past when it comes to Greece.
I think the key spillover effect everybody really wants to know about is whether or not what's happening in Greece has the potential to make Janet Yellen hold back and delay the rate hike.
Exactly. And the interim connection between that is, how would Mario Draghi respond? What would be the spillover effects in the rest of Europe? Would there be an anticipation that Mario Draghi would have to ramp up his support for the European economy to limit some of the spillover effects? I think that's very unlikely, but that's what bond markets would be looking for. And then the U.S. impact onto Janet Yellen. First, the market impact is that if Draghi's doing more, if European bond yields are going lower, then it puts some pressure on U.S. interest rates. And then if there's an economic spillover effect, it gives Janet Yellen and the Fed more reason to delay the long-anticipated liftoff.
Yeah, I mean, if you add all of that to a possible really strong jobs number tomorrow, our own economist Richie Yamarone is forecasting 320,000, which is obviously way above consensus, but that makes it, in his argument, harder for Janet Yellen to raise rates because the dollar strength would really affect our economy negatively.
Yeah, I think the dollar strength argument is harder to make now just because of how much dollar strength that we've already had. And we really priced in a lot of that differential of European growth versus U.S. growth, which created the strength in the dollar versus the euro, so that the marginal jobs number isn't really going to lead to another 25% increase in the dollar. Yes, we think the dollar will go stronger, but not significantly stronger from here, so that it really changes the story for the economics to change Janet Yellen's perception.
Goldman Sachs, which has admittedly been a real euro bear, is now saying 95 cents, so below parity. If we get 300,000 and we raise rates while Europe is doing even more QE, doesn't that just shift it a little bit too much?
Well, it certainly shifts it, but the issue is it shifts it, and that story has been in the market for a long time. Yeah. So I think, yes, there's some marginal strengthening, but it's not the big move that we already saw, 25% increase. We saw the hit to exports. A lot of that's baked into the market, so you really need a new story to get the dollar to significant levels to change Yellen's perspective.
In the second quarter, the euro had a great 3-month span versus dollar. Very different story in the U.S. Treasury market.
Yeah.
It was actually the first negative quarter for the U.S. Treasury market since 2013. Jeff, there was a story on the Bloomberg Terminal this morning saying that fixed income investors have never been quite so vulnerable. Global debt markets saw a 2.3% loss in the second quarter, the biggest reversal on record. How does it feel out there trading in these markets? Are you sort of more nervous than ever that one big move one day could turn into a bad year?
Well, I think that the issue for fixed income investors is that they've had a lot of years of pretty decent returns, and they've been rewarded for reaching for yield and taking on more risk, not just in their fixed income portfolios, but throughout their portfolios. And they've been forced to do that because of zero interest rate policy. Investors need income. Fixed income investors need income, right? We're talking about older investors. We're talking about people on a fixed income who need income. There's no interest rate in a zero interest rate environment, so they've had to reach for yield. That puts more risk in their portfolios because the kinds of assets that provide that kind of income and yield are higher risk. So that's where your vulnerability is to any sort of shift, whether it be an interest rate shift or shock in Greece, a shock in Puerto Rico, the other stories. The vulnerability is that people are overextended, and you have not a lot of cushion in market pricing.
Is it time to dial that back? Howard Marks was telling us this morning, time to dial that back a little bit.
We've been talking about this for a while now, dialing back, rebalancing a portfolio between your reach for yield needs and your preservation of principal. And we've been saying, let's take down the income, at least tactically. We know that's painful in the short run, but we want to preserve principal a little bit more. So we're pretty defensively positioned going into the summer, going into some of the events.
And you like the belly of the yield curve.
And then in terms of yield curve positioning, we like the intermediate part of the yield.